Hey, what's going on everybody, this is Gary, and in this video we are going to talk about gamma squeeze. If you guys not very sure what is short squeeze, I've made a video on short squeeze, the links in the description box below. So for now, gamma squeeze, it involves somewhat a complicated world of options. And if you guys not very sure what is options, fear not. I'll do my best to make it as simple, as easy to understand as possible. So now, SpongeBob. Okay, SpongeBob, and right now we look at company ABC. SpongeBob, company ABC. Now, company ABC is trading at $10 right now. And SpongeBob, he decided to do research, due diligence, and he realized that actually company ABC is earning money. Earning money, it is worth more than $10. And SpongeBob said, I'm bullish on company ABC and I think its value is actually higher. Alright, higher than $10. That's what SpongeBob thinks. And SpongeBob decided to buy a call option, which is a contract with a strike price, a layman term, which is target price of $30. Meaning, a call option means a right to buy 100 shares at $30. Okay, so that's a call options, the out the money call options. So that's what SpongeBob did. He buy a call option. Okay, if you're not very sure, just understand that he bought a call option with a strike price of $30. Now, SpongeBob being the buyer, there must be somebody selling the contract, right? He buy a contract, he buy a call option. There must be somebody selling that particular call options. So the person is the market maker. Right, the market maker, it can be Bank of America, can be any those big corporation. Why they decided, to be the one selling? Because they want to make the market, right? And they earn through commission, they earn through many different ways. As long as somebody buys, as long as there is any transaction, they earn money. So that's why market maker wants to make the market, and they sell whatever SpongeBob wants to buy. So therefore, SpongeBob, he buy the call. Market maker, he sell the call. Right, SpongeBob buy the call. Now, right now, SpongeBob buy the call, he has a delta positive. Market maker, delta negative. If you guys not very sure what is delta, let's take a look. So there are a lot of more definition to it, and a lot of nuances as well. But in this particular video, for those of you who are not very sure, delta is in short the probability of success. Probability of success. Say for example, if 0.2 delta is actually 20% chance of achieving price target before the expiry date. Again, 0.2 delta means 20% chance achieving price target before expiry date. So now SpongeBob has a delta positive, which is when price increase, it is good for SpongeBob. He wants that to happen. Okay, if the price drop, is bad for SpongeBob. Vice versa, if delta negative, price increase, it is bad for the market maker. Vice versa, if price decrease, it is good for market maker. Okay, so that's all you need to know for delta as of now. Now let's zoom into the market maker. Obviously, market maker, they provide a lot of transactions, so therefore they don't like risk. They don't like risk. Whether positive delta or negative delta, they don't want it. What they want is they want it to be neutral. Delta neutral. They want it to be neutral. So in order to be neutral, just now they were having a negative delta. So in order to be neutral, delta negative is 0.2. Take for example. So since one option is 100 shares and delta is actually equal to probability of success, then 0.2 times 100 shares is actually 20 shares. So what does it mean? Meaning, when SpongeBob decided to buy a call option and market makers sell that particular call option, then immediately the market maker will need to buy 20 shares at the current market price to hedge away the delta negative, right? So basically they want it to be delta neutral. That's all you need to know. Whenever they sell a particular call, they will turn around and buy shares of that call, so that in case SpongeBob managed to exercise his shares, then he has some shares to actually sell to him. What market makers want is to have shares available in event that SpongeBob wants to exercise his shares, his options. So now right now the price is $10, the delta is 0.2, therefore he buy 20 shares to hedge away his negative delta. So what if the price increased to $13? As you can see over here, the price increased to $13, then delta will increase, right? Delta increase, and with delta increase, say just now was 0.2 and now say 0.7. So 0.7 minus 0.2 is 0.5. So 0.5 times 100 is 50 shares. Over here, as you can see, 50 shares at $13. So he need to buy 50 shares at $13 to hedge away the delta negative. So take for example. So what if the price increase even higher? The price increased even higher to $35. Then what would happen? The delta would be higher, right? For those delta negative, positive. For delta positive, SpongeBob would be happy, and delta would increase. And when that happens, the market maker, in order to hedge away the negative delta, what they need to do, again, they need to buy more shares to hedge away the negative delta. So I'm sure you have thought about it. So if they buy more shares, wouldn't that cause the price to increase? Yes. When the market makers buy more shares, the market price would increase, right? Higher demand, the price will increase. So therefore, it will cause a loop, right? When price increase, market makers need to buy more shares to hedge away the negative delta, and therefore the price will increase even further, and then they have to buy more shares, and this causes a loop. So that's the relationship between SpongeBob, the buyer, and the market maker. Now, if right now at price at 35, what SpongeBob can do is, firstly, he very excited, post on Instagram, whatever, but firstly he can sell the contract for money, because obviously his contract worth more right now. He can sell the contract for money, or he can exercise the contract, meaning to buy 100 shares at $30. You notice the market price is at $35 right now, and he has the right to buy at $30, meaning if the market makers initially didn't buy at 20 shares at $10, 50 shares at $13, if he didn't do that, right, he would need to buy 100 shares at $35 and sell to SpongeBob for $30. So meaning he make a loss. So that's the reason why he initially bought some shares at the earlier stage. So that is the reason why. So what if there are a lot of people buy a lot of that particular call, right? A lot of people buy the same call, then the market maker has the price increase. He need to turn around to buy a bulk of shares to hedge away the negative delta, which in turn causes the price to increase, right? So there's this loop of, if price increase, market makers need to buy more shares and stuff like that. So there is this loop and causing the price to increase from $35 to $40, and therefore they need to buy more, and then causing the price to go up to $45, and so on and so forth. So what if, right, SpongeBob and he created a Reddit community or Wall Street Bet or whatever? There are a lot of people join SpongeBob in buying this company ABC. Then a lot of people buy the options. Then the market makers, what we need to do, same thing. If the price increase, they need to turn around to buy more shares to hedge away the negative delta. So this loop will continue and continue and continue all the way, right? That's why the price will rise exponentially. When that happens, the price rise exponentially. And remember, if you guys, for those of you who watched my previous video, which is about short squeeze, that it means that the short sellers are panicked when the price increase, and a lot of buyers here, they panic. So if you combine the two together, the gamma squeeze, right? Market makers need to buy more shares when the price increase, and then when the price increase, the short sellers are panicked, and therefore a lot of people start to buy, right? Because then FOMO buyers start to come in. So in short, you can read this. As you can see how these two things, the short squeeze, the gamma squeeze, work together. Investors get very bullish on a heavily shorted stock and start to buy common shares and calls, right? A lot of SpongeBob, a lot of Jimmy decide to buy shares, a lot of them buy calls. As the stock rises, short sellers will get pressured. market makers will buy more and more shares to properly hedge their positions, and bulls will get more and more bullish. I mean, come on, when price increase, a lot of people start to buy. The FOMO traders start to come in, and this create a positive feedback loop. Buyers buy, market makers hedge, short sellers buy back shares to get out of their short position, and therefore it caused a explosion. All right, it caused a explosion. An explosion, I'm sorry. It caused an explosion, and just like, for example, the OG, GameStop, all right? We take a look at GameStop, AMC, and I do feel that Clover has its potential as well. All right, guys, that's about it for this video. As usual, this is not financial advice. This is just me sharing with you my personal opinion as well as my research and due diligence. If not, I'll see you guys in the next video. Stay safe, trade safe. Bye.